morning to all clients tuning in for our weekly webinar. Benjamin here speaking on the line, covering the finance and offshore sector. So today's webinar is pretty straightforward. It's more of a stock picking session. So first of all, I'll be giving an update on Sarine Technologies, right, which saw quite a bit of action over the course of last week. Right, so give us some update on that front. And following that, our consumer analyst Shane, right, he initiated on Q&M Dental last week, so he'll be sharing that idea with you guys. It's pretty interesting, so tune in for it. Right, first of all, on the Sarine side, right, so last Sunday night there was an profit guidance that was issued, right, so I'll elaborate a little bit more on that. Right, you saw the share price tank about 25% on Monday itself, and then following that, it has rebounded quite a little bit, right, on internal share buybacks, right, as well as some of the insiders increasing their position. Right, so first up, again, profit guidance was issued on Sunday night. Alright, so what happens is that for the first quarter 2015 results, which is coming up probably at the end of the first week of May, alright, revenue on a year-on-year basis should be down about 50%. Alright, for the quarter itself, it should be break-even, i.e. Probably zero, or that's plus minus 500k. Alright, in terms of expectations-wise, right, we have consistently been highlighting this across from the last quarter of the year. Right, so around November period, we highlighted the potential soft quarters ahead, and we emphasized on that as well during our February update. Right, and similarly across the street consensus for some other houses covering, right, we were also aware of the situation that was going on within the diamond industry. Alright, so basically, in a nutshell, alright, what happened is that we are seeing a downturn in the external industry itself, right, that Sarine is in, basically the diamond industry, right, but the company itself is still fundamentally sound. Right, so what surprised us as well as the street consensus, right, was the magnitude of the impact that we have that will possibly happen. Alright, so within the diamond industry itself, right, there were some issues that has been pertinent since the end of last year, alright, whereby on one end the polish demand was slowing down at the end of last year, but it started picking up in February, right, due to the some of the festivals like Chinese New Year, Valentine's Day, right, but on the supply side, right, which is the supply of diamonds by De Beers, right, the largest diamond supplier, right, they were holding up the prices of the rough diamonds that were being sold to the diamond polishers, i.e. the polished diamond manufacturers who sit in India, right, but the reason is that when the rough prices are being held up too highly, right, the diamond manufacturers, when they buy those diamonds to be part of that inventory, it will result in them having a higher cost of sales, alright, and therefore they'll be pushed to unprofitable regions. Right, so for that fact, if your diamond prices are too high when you buy it in, alright, when you're forced to buy it, right, the manufacturers will tend to sort of decline the diamonds being offered for sale by De Beers. Right, so the last site holding, right, which is a session where they buy the diamonds, about 30% was left on the table, right, so 30% of diamonds were not bought up, right, so because of that, the volume came down within the diamond manufacturing industry, and therefore it affects the revenue of Sarine. Right, so the end conclusion is that we don't think that this is a bad situation. Alright, yes, it's unfortunate that these things are developing in the market, but this is not the first time it happens. It's always a to and fro kind of session, game of chicken between De Beers as well as their clients, which are the customers, which are the diamond manufacturers, right? So this happened sometime in about 2 years ago as well, right? Just that for this period it's slightly prolonged, right? So both De Beers as well as the Indian and diamond manufacturers, they are dependent on each other, right? So De Beers has to sell the diamonds no matter what happens, right? Because they're essentially miners, right? So the diamonds form part of their inventory, and they need to offload this, right? So it's a matter of time, all right, when DBS will cut the pricing, right, so that they can offload the diamonds, and then that's when we will see the supply side issue getting rebalanced, right? So there's no doubt that this situation will reverse, all right, and we expect this to happen, right, sometime towards the end of the second quarter, right. So we'll look for early signs of development in the first week of May, right, where there's a buying session for diamonds as well as a trade show that's happening at the end of May. Right, so all in all, right, the company is still fundamentally sound. We have reduced the revenue forecast, right, in line with the possible impact, right. So the customers are not cancelling any of the orders; they're just deferring it, waiting for production levels to come back up. So potentially we're looking at a 48% upside to current price levels, but extremely attractive buying opportunity. Right, so this is just to give you a flavor of what's going on. Right, so if you look at this slide, this is the polished diamonds, and this is the rough diamond pricing. So the spread has been increasing, right? So it makes it more difficult for the diamond manufacturers to essentially make money, right? So from the upstream, when they translate the upstream diamonds into polished diamonds, all right, only 7B of value is created. Whereas if you look from the polished diamond side, and then they translate it to the jewelry segment, right, the value creation is about 3 times the amount. Whereas for this, it's only a mere 7B. Right, this is a consultation paper from Bain & Co. Right, so they are the only one that is commissioned to do diamond study. Right, so we look at the midstream segment, which is the diamond manufacturers, right, essentially the ones who polish the diamonds. The operating margin, right, averages at a pathetic single-digit percentage. All right, so that means that if my cost of materials increase, all right, my operating margin could potentially drop to negative regions. So that's why they're turning away the diamonds being offered by DBS, right, which henceforth leads to lower manufacturing activities. Right, so look out for the turn in the industry, all right, and for 48% upside. Right, with that, I'll hand over to Shane to talk about Q&A.
Hi, morning everyone. We initiated on Q&M this morning, so we have a target price of, with an accumulated call, we have a target price of 78 cents. The last closing price on Friday was 72 cents. Last I checked before I came here was 74. So based on the 72 cents, we are looking at upside of about 9% including dividends. So in the last 1 year, Q&M has seen a tremendous growth in the stock market. So it's gone up about 93%. But we still expect a little bit more upside, and with this presentation, hopefully we can show you why we think there's upside potential. So we have grouped Q&M into 2 parts. We have the Singapore story as well as the China one. We'll touch on Singapore first. We see a roll-up story in Singapore, and this has happened across many industries as well, whether it's a food court, whether it's the medical side, which is the Parkway Group, that we see companies, they are starting to professionalize industries. They are starting to group them under a single brand, and this allows them to enjoy economy of scale in their cost savings as well. So in Q&M's case, they have increased from 1 clinic in 96. By end of last year, it was actually 60 clinics. So this translates to about a 9% market share for both the by clinics and by dentists that we see in Singapore. They are owned by Q&M. The industry overview is that the dentist to population ratio in Singapore has been falling from about 3.8 thousand per dentist in 2001 to about 2009 in 2013. So this fall has been contributed. Population has been growing in Singapore, that's definitely, but we have seen a stronger growth in terms of the number of dentists that are coming out of NUS. And in Singapore, the key supply of dentists is from NUS. So we do see dentists coming in from overseas, but not so much. So it's mainly locally driven. However, despite the fall that we see in dentist to population ratio, we still see it as higher compared to other developed countries. So the mean that we see across developed nations is about 1,006, and we think that Singapore has some way to go to narrow out this population this dentist density that we see. And one key thing is that as a consumer, we rarely really go for dentist checkup. I mean, the latest stats is that about 40% of the population goes to visit dentist once a year. And one key thing is that dental, we don't really go unless there's a toothache, like you think that you have to go. Apart from that, you really don't want to go there. So, whether it's a child phobia or something. So, the government however, we see that government has been easing dental costs via a scheme that was started, I think, early 2000. So over the years, this community health assistance scheme has actually had several enhancements, some of which include the increase of the household income that it covers under. The other one is the removal of age, where previously it was, I think you had to be age 40 and above. Now there isn't that criteria anymore. So this enables more people to gain access to this health assistance scheme. And as a percentage of GDP, Singapore's government has been growing over the years, how much they're spending on them, and in the latest FY14 is hit about 1.9%. So on top of that, QNM actually has their own further subsidies for 3 basic dental treatment that we see at the bottom chart. So these are the consultations, scaling, polishing, as well as filling. And we view this part very positively because it's not an expensive service that QNM is subsidizing, but it allows them to gain more customers at a very cheap cost. So if you're a customer and you're thinking that you want to do these 3 treatments, why not go to QNM? Because they offer subsidies that other clinics may not offer. So this allows QNM to come in, attract the crowd at a very cheap price, but and after that they're able to upsell the consumers. So we view this positively. And moving on into China, China lags the other developed markets in terms of health expenditure. So if you see the chart on the top right, China is at about 5% GDP, and this is pales in comparison to other developed nations. However, we do see that it has been increasing since 2007. So if you see the GDP, as in the per capita health expenditure in China, it has been increasing over the years, and largely the increase has happened about 2007 onwards until now. So these are driven both by the government and social sources. So if you see the chart on the bottom right, the gray one is out of pocket, meaning what the consumers are coming up with. So in early 2000, it was about 60%, but this has fallen to about 34%, and the shortfall was made up by the government and social aspect of social funds. So in China, there are key criteria. Unlike Singapore, they choose to expand organically, meaning to open their own new stores, and they'll only acquire if there's a specialized skill that they find in Singapore. However, in China, out of 4 units that they have over there, 3 of them are acquired. And they have highlighted 4 key acquisition criteria, which are ground knowledge, location, demand, and supply. So I'll touch on all 4 of them. Ground knowledge is the understanding of what the consumers actually want. And by acquiring someone who has a hospital, who has a clinic over there, not only do they gain the expertise, at the same time they are gaining a partner who has a proven location, which falls into the second point. So the location is scarce in China simply because about 90% of the Chinese healthcare market is run by the government, so public sources. But the government wants to shift these funds into the private side. So instead of 10% from private funded, they want to shift it to 20%. And the fastest way for them to do that is to sell the public houses, public hospitals, public clinics, and this is where overseas investors such as QNM have an opportunity to come in. So last year they acquired 2 companies. One had hospitals and one was a manufacturer. So this allowed them to move upstream because they're able to manufacture supplies that the clinics are using. At the same time, they're able to expand their store count in terms of the hospitals. So location is sort of helped by the government. So demand is the customers that QNM's hospitals have in China. So are people actually coming in? In China, there's this insurance called Yipao, and Yipao has 2 tiers. There's a basic tier and there's an advanced tier. So the basic tier is a fixed sum that the government gives its citizens every year that the citizens can use it for their basic medical care. So this includes visiting to a doctor, whether you have a flu, a cough, and it includes the basic dental health checkup. So what the company has seen is that although the basic tier is actually carried over to next year, the citizens are not bringing the sum forward, so they are spending it in the year that they're given. For the advanced tier, the government subsidizes about 60 to 70% of advanced dental procedures. So this gives them, this helps the citizens to ease their dental costs. And because most of this money are coming from the government, there's a very low collection risk that QNM faces. Lastly is the supply, which is the supply of dentists. In China, the supply of the population per dentist is 5.6. If you remember, Singapore's number is 2.9, so China is double. And what QNM has done is to tie up with a university called Liaoning. So Liaoning has a dental school where it produces dentists, and QNM has actually had an education fund that helps to ease the education cost of these dentists. But in return, QNM gets the first right of refusal to hire the graduates and to sponsor them for master's program if they think that the graduates are suitable. So this helps QNM solve the supply issue of dentists. One key thing is the protective mechanism that we have seen for the two latest acquisitions. We think this is a very good sweetener for QNM. So protective mechanism has a few phases. The first is a profit guarantee that they have for the next 12 years. So regardless of what QNM is able to, it knows for certain what it's going to get from these companies at the very least. So this is a floor that you see for these companies. If the amount that the company earns is not enough to hit the profit guarantee, they are able to take the shortfall from their partner to make up until they hit the profit guarantee. If after taking it, they are still unable to hit the guaranteed profit, QNM is able to take the equity stakes from the partners. So in worst case scenario, QNM will end up with 100% of these companies. So moving on into the assumption side, we do see that because due to the acquisitions that they have done over the last few years, we see that manufacturing and distribution has been growing. Manufacturing has been growing pretty quickly in the last 2 years, or in last year, and we think that going forward it's going to increase because manufacturing only accounted for about 4.5 months of revenue last year because it was acquired in mid-August, and we think that this has room to grow for the next 2 years. However, because manufacturing and distribution have lower gross margins compared to the clinical revenue side, we think that this will result in a higher percentage of COGS in total costs. So to put things in perspective, for the dental and medical clinics, COGS only constitutes about 8% of revenue, whereas for the distribution side, it's about 70%, for manufacturing is 30%. So naturally, if the latter two, the distribution and manufacturing business, are growing in revenue in terms of segment mix, then we do expect to see a higher percentage of COGS. Nonetheless, we still think that employees' benefit is the key cost component that QNM will face even moving forward after the higher percentage of COGS. But one thing that we like to talk about their employee benefits is that it's largely variable. So it's commission driven by the dentists. So they have their corporate office, they have their dental assistants and all, but the key component of their employee benefit is coming from variable. And we think that this is in line with growing revenue. So if dental and medical clinics revenue is going to go up, we will see an absolute number, employee benefit is going to go up. However, as a percentage, we don't think that it will make too big an impact or any impact into the bottom line. So these are projection for its net profit and EPS moving forward. We do see a strong uptrend coming up. And lastly, the risk factors. So the three things that we think are that pose the biggest challenge to QNM are the below expected execution in China. So while they do have a profit guarantee and the worst case scenario where they take the equity stake, we do not think that that's what they want, because QNM has the intention of listing their Chinese business separately, and this is definitely going to be a good thing for investors if the Chinese business is doing well. So they'll want it to work as much as possible. However, there's still this risk that, as in China, some things may not always, or most things doesn't go as planned. Then we do have a rise in labor costs. As mentioned earlier, that labor cost is 56%. We expect to be 56% of total cost. So we think that any spike in labor costs could impact the bottom line. And lastly is the saturation of dental outlets in Singapore. QNM has highlighted that in the east side, where it does not have too big a presence, that's where they'll be focusing their opening of dental outlets of 5 to 6 stores 556 stock is for the whole of Singapore per year, but the focus is going to be on the east side. And we think that if other people start catching on to the dental outlet, starts opening up, that if this situation does get to a worse state, that QNM may face limited options in terms of opening new outlets in Singapore. And that concludes our webinar for today, and we open the floor to Q&A at the moment. Hi, we have a question for QNM, which is a business split between China and Singapore. On the top line basis, Singapore constitutes about 77%, Malaysia is 9%, China makes up 14%. There's another question, which is the profile of substantial investors for QNM. So if you have a look on our report, the more than 50%, about 53%, are owned by Dr. Ng Chin Sao. So he's actually the CEO and founder of QNM. And we think that this creates a very strong alignment between the success of QNM and his own personal net worth. So we're quite confident of this aspect. During our visit when we talked to QNM, they were shared that Dr. Ng spends about 50% of his time in Singapore and 50% in China. So we think that this is a positive view in terms of where they want to grow their company, and that's why in our report we also mentioned that we do not expect them to grow as fast in Malaysia, whereas the growth is going to come from both Singapore and China.
Hi, Benjamin here, speaking on the line. I have a couple of questions with Sarine, so I'll try to address them one by one. First of all, I have a question on how much shares has management of Sarine bought back, alright, and what they said they will buy. Right, for them, they do not disclose how much they will buy, so it's up to their own discretion. But internal buying of shares, of course, shows the confidence of the management for the company's performance coming down the road. Alright, in terms of the internal share buyback, they took back about 0.33% of the open market last week on the 15th of April. Alright, on top of that, various directors have also been buying shares almost on a daily basis. We check the SGX announcements. So each one of them is buying about 50,000 to 100,000 shares, right, off the market. Then next up, I have a question on the dynamics of the diamond industry. So let me break it down to you in a couple of minutes. Right, for those of you who are unfamiliar, right, I think it's quite good to know how it works as well. Alright, so the diamond industry is the same as any sort of commodities value chain. Right, so first of all, at your upstream side, you have your miners. right? Basically guys who mine for the diamonds. So there are only a couple of players who are big enough to affect the market. First of all, you have De Beers, who I think most of you might be familiar with, where they control about 40-50% of the diamond market. But essentially, these are the guys who provide most of the supply, right, of diamonds to the market, which end up as jewelry that we buy in the end. The next one will be a Russian national company. Alright, so just about these two, they control about 80% of the supply. Right, next up, we move on from the upstream, right, where you mine for rough diamonds. Move on to the midstream, right, where it's a transformation of rough diamonds to polished diamonds. Right, so polished diamonds will ultimately end up downstream in the jewelry segment. Right, so the midstream, where people polish and manufacture the rough diamonds to polished diamonds, that is most of the players sit in India. So they produce about aggregated between around 90% of the world's volumes of diamonds. Okay, so that's by weight. By value, about 60% for India. So you have other traditional hubs like in Belgium, Antwerp. Well, there's a couple of one in a couple of manufacturing centers in Africa. China has a bit of market share as well. Right, so that's for the midstream side. Downstream side, you have it's a very fragmented market. That's where the jewelry segment is. So you're talking about your Cartier, Tiff and Co, and all the other various small, tiny jewelry sellers. All right, so this how the diamond value chain works. Miners, manufacturers, they ends up right in the jewelry segment. Right, so in terms of value creation wise. Of course, the manufacturing side will be the least value creation. The highest amount of value creation comes in the last part of the value chain, right? For the upstream side, essentially because it's almost like a duopoly, right? That's why a lot of the value is created from there as well. Then I have another question: why is rough diamond price being underbidded now? Alright, rough diamond price not being underbidded. Alright, rough diamond price is being held up, right? Maintained at a level, quite a high level. Alright, which essentially is the price that De Beers as a miners offer to the manufacturers. Alright, so they force you to take a bag of diamonds. You cannot see what's inside the bag of diamonds. Alright, but they just roughly tell you what is the price. Right, so when it's held at a price that is unacceptable to the people who buy it, right, that's where we saw that a lot of diamonds were essentially left on the table. Right, so that's why the production volume is down, because people are not taking in the diamonds. Right, so De Beers is holding out the pricing because they are a listed company, alright, and they want to maximize profit. That's why they always try to push the button as much as they can until it cannot be withheld in terms of the pricing, and then they will lower it, right? Because essentially everyone is dependent on each other. If I cannot sell the inventory, I don't make money, right? Alright, so let's take one more question for Sarine. Given De Beers' resistance to bring down the price, many think it's the time for entry, Sarine. Alright, most of the diamond players are actually looking for the pricing to start gradually being reduced in the May period. Alright, but that is what people's expectations are. At this point of time, alright, the price for Sarine is extremely attractive. Right, but do note that there might be some short-term correction once the real results are out in May. So if you don't want to take the risk, maybe you can wait until the first quarter results are out and wait for a bit of more confirmation in terms of how the diamond market turns out, right? So which hopefully will give you an update once we see any developments on that front, alright? But for our expectation, probably the softness in terms of results performance will likely drag into the second quarter, right?
Hi, we have a question on Q&M. So the question is, what is the competitive advantage of Q&M over other dental clinics? Based on our talk with the management, we've identified that Q&M, in terms of their dentists, they are actually quite motivated because, as you mentioned, that they are a sole proprietorship. So, and as we talked about earlier, where the labor expense is the largest component of Q&M. The reason being that the dentists in Singapore are paid mainly on a commission basis. So this makes them want to sell more because this directly impacts their own salary that they bring home. In terms of the experience or the specialization that they do offer to their clients, what we see for Q&M is when they acquire other companies, other dental clinics in Singapore, they look for someone with specialization that they currently do not have. So when they acquire these specialized skills, they will sign an agreement with the CEO or with the main dentist of the clinic, and they will get the main dentist to teach them to impart the skill sets that they have on that specific procedure that they're specialized in. This is then passed on to the other dentists around the Q&M group. So as a whole, the whole group is able to benefit from this acquisition and not just the corporate side, which is that all the other dentists are able to learn what their specialized skill is. They're able to expand their service offering, and then they are able to offer more procedures to their clients. So this is one key thing that we see when they acquired. In terms of the competitive advantage, this translates to them being able to offer more skills as a whole group versus if each one were to operate individually. The next question we have on Q&M is the subsidy given by Q&M. Is it on top of the community health assistance scheme? So our understanding, yes. However, if you see the table at the bottom, there's this one component called sterilization and disposable fee. This is non-subsidizable, so the client has to pay this fee. The next question is does it mean that Q&M is cheaper than its peers? We don't think that's to be the case for every procedure. We do have in our report, actually on the page, give me a moment, on page 6 of our report, we actually have a breakdown of the dental prices that the clients are faced with in Singapore. So we have public institutions, the private dental clinics, as well as Q&M. So on some procedures, such as the full dentals, we do see that Q&M is actually cheaper than the other private dental clinics. However, there are some procedures where Q&M falls somewhere in between. So I think it will differ from clinic to clinic, that some private dental clinics will be cheaper than Q&M, some will be more expensive than Q&M. Just to highlight three things, which is the root canal treatment. So there are three types, which is anterior tooth, molar tooth, and premolar tooth. If you compare the private dental clinics, even at the highest price that private dental clinics are charging, Q&M specialists are charging higher. So in this regard, Q&M is the price leader for these three treatments. But for others, such as the full dentures, Q&M is cheaper than the other private dental clinics.
Hi, Benjamin speaking here. Right, I have a number of questions again on the diamond market, which I will try to answer to the best that I can. Right. First of all, I have what's the current price level for rough diamonds? Based on response from the diamond manufacturers, how low would you expect De Beers to reduce the price? Alright, current price levels, we look at it on the aggregate index basis that's provided by certain diamond data providers. Right, so that is some of that data is proprietary, so you can't really find it offline without having paid subscription to it. Right, so a brief background is that rough diamonds is similarly for polished diamonds. If you guys have bought diamonds before, alright, it's not priced on a fair basis, right, according to the size, which is the carat, color, and so on and so forth. It's not a uniform pricing level, alright. So usually there's a different pricing tier, right, for different sizes of diamonds, right. But on the overall basis that we have for the index wise, the rough diamond prices is evidently being held up, right. And then for the polished diamond side, similarly, it's also not priced uniformly. So in terms of the how much De Beers is willing to reduce the price, alright, there's no specific range in mind, because that depends on what kind of sizing and properties are we looking at when we purchase the diamonds. Right, so I would say anything between 10 to 20% in terms of the reduction in price. That's roughly the range that we got, right, from talking to some of the diamond guys. Right, so that's the first part for how that answers your question, right? And then I have another question on does Sarine dominate their segment of the diamond industry? Yes, they do. Alright, so they have basically 3 product lines currently. Right. First one is they've been doing it since the 1990s. Alright, so their part is a lot to do with providing equipment and technology on how you plan to cut a diamond to maximize your yield. Alright, amongst that you have stuff like laser grading, laser inspection, grading type equipment that is used across some of the world's largest labs, like AGS, GIA. Alright, some of you might be familiar with that as well. Right, so most of these labs use that equipment. Right, for the manufacturer side, they use a lot of their planning equipment and basically technology to aid them, right, in polishing the diamonds. Alright, so that part they have about anything between 70 to 75% market share. Alright, so basically you can conclude that they are a monopoly for that segment. Alright, the second one, which they launched in 2009, right, which is also the reason why we initiated them in the first place, right, is the first of its kind technology that helps them to see inside a piece of rough diamond. So rough diamond looks like a piece of rock, right? That piece of tech helps you to see inside and determine how where are all the flaws in diamond, basically to help you to improve the clarity of a diamond. So if you are familiar with diamonds, you know what is VS1, VVS1, VVS2, VS1, VS2, and so on and so forth down the grade. So that helps you to achieve an internally flawless diamonds, or optimize the diamond to cut to get a diamond that is of the highest value possible when you can sell it. Alright, so it's the first of its kind tech. So therefore, for that part of the diamond industry, in terms of the market, addressable market that they created, alright, essentially they are 100% in terms of market share, right? But we need to look at market penetration when we look at it, because 100% market share doesn't mean you have penetrated the market fully yet. Alright, so in terms of market penetration, we're looking at between 30 to 40% after about 4 years of product launch. Alright, so still quite a long way to go, right, before we can hit we would say 75% market penetration. Right, so now there are no competitors for it. Right, so I hope that addresses the questions that we have on Sarine. So please feel free to ask any more questions that you want.
Hi, we have a question on the increase in the healthcare and pharmaceutical companies in recent days. Some such as Biosensors, Revosmat, Q&M. As of now, we do not cover any of the others, so we can't comment on whether we see any laggards. Yeah. The dividend yield for Q&M based on our forecast for next year is 1.6%. Q&M doesn't disclose the breakdown in terms of the revenue, whether it's a cosmetic scaling, tooth. But if you go based on the dollar cost, the consultation, scaling, filling, they are a lot cheaper compared to the bigger items. So you can have, easily 10, 20 people coming in for the basic procedures and one guy that comes for the more advanced procedures, and you're starting to see, you see a huge revenue contribution from the advanced procedures. Our fair value for Q&M is at target price of 78 cents. So this is about a 9.4% upside from its closing price on Friday. Yes, the chart shows that it's a record high. It came down a little bit last Thursday, and whether we think it's richly valued, we think the closest competitor is actually a company called Top Choice Medical Investments. So this is listed in the Hong Kong site. We think that on Friday the PE was about 126 versus Q&M's 42. So, but naturally you are going to account for difference between Hong Kong and Singapore. And on top of that, Top Choice is growing at a faster rate with better margins compared to Q&M. So we think that the premium that we see for Top Choice is justifiable versus Q&M. However, it doesn't. But Q&M, the way we view it is that we're using Q&M as a proxy to go into China's dental market, which we see to be attractive. So the valuation may come down, but that will be largely dependent on how Q&M performs this year, especially from China.
Some inquire on the two announcements made by China over the weekend. One is on margin restrictions, and the other one is on the cut of required reserve ratio. So, how do you think these measures will impact the A50 as well as the Shanghai stock exchange composite going forward? So, let me break it down to two parts. Okay. Actually, it's not a confusing or contradicting announcement, in the sense that the margin restrictions is mainly to manage risk and to rein in speculations, especially on the smaller caps, while on the cut of required reserve ratios are actually trying to the Central Bank of China is trying to inject more liquidity into the system, and also to bring down the real financing rates in China, which is currently still quite high. So they are trying to stimulate the credit cycle in China, and thus try to boost more economic activities to support their the slowdown in the GDP. So moving forward, as I mentioned earlier, because that the margin restrictions it mainly will affect the smaller caps. So A50, which consists of mostly the large caps, so it won't be affected that much. But as for the whole Shanghai Stock Exchange composite, as a whole, we are still quite optimistic on the China market, and we still think that there will be more stimulus measures coming forward, and thus we are still expecting it to we are still expecting the upward trajectory to be to maintain.
Hi, Benjamin here. I have a question on companies in Singapore that grows diamonds, and will this significantly impact the industry? Alright, that you're referring to will be basically laboratories that grow synthetic diamonds. Yes, there are a couple of players here in Singapore. They are private, right? So there's not much information on it. But looking across the board, when we look at the synthetic diamonds, currently, about 90% or so of industrial usage diamonds are synthetic diamonds, right? So it's already existing, alright. But in terms of growing it to a sizable carat, in order for it to be of gem quality, alright, the tech is not there yet to grow it to that size, alright. So usually you need at least above 3 carats in order to be polished down to anything between 1 to 2 carats or so, right, for the gem quality diamonds. Right. So of course, the industry itself, they do have some concerns over this. Right. In fact, recently, currently there's an ongoing conference with regards to discussion on how the diamond industry is going to tackle the issue of synthetic diamonds. Right. So in terms of if you're referring to the impact on the industry, right, currently there won't be any accessible impact, right, because of the fact that synthetic diamonds are essentially different in terms of sentiments for people who purchase gem quality diamonds. Of course, you're talking about industrial wise, people really care, right? But for gem quality wise, I think what they are trying to tackle, right, for the larger jewelry sellers is to be able to identify any synthetic diamonds that might potentially be thrown into or mixed together with real diamonds, right? So that people don't get cheated when they pay for real diamonds versus synthetic. I mean, essentially they are the same, one and the same compound, right? Just that it's a bit of a market psychology, right? Because it's so ingrained into people's mentality that they have to pay for a gem quality diamond, right? So roughly that is how the development is like on the side of synthetic diamonds that you are referring to. Okay.
Hi, we have a question whether QNM is in a trading buy or a FA buy. We have actually scripted away our trading buy, so our current ratings now are either buy, accumulate, reduce, or sell. And for accumulate, we are looking at an upside of about 5 to 20%. So that's how we came up with the accumulate call for QNM, and this is based on the fundamental.
Hi, this is Lindsay. Someone asked about will the Chinese monetary easing help banks like Bank of China? And another question would be also will it help the share price in the Hong Kong market, HSI? So basically, with China, with PBOC cutting down required reserve ratio, so banks would, especially big banks like Bank of China, would be able to lend more and hence prop up their profits. And in that sense, yes, because Bank of China is also listed in the Hong Kong market, and they are actually trading in the discount in the Hong Kong market as compared to its counterpart in the Shanghai Stock Exchange market. So yes, in that sense, we'll see that the Hong Kong market would still be in demand compared to the Shanghai Stock Exchange.
Okay, Benjamin back here again. Alright, we'll take one last question, which I think should be quite applicable for everyone over here. Alright, there's a question on the update of the Singapore offshore and marine sector as well as oil price. Right, first of all, let me start with oil price first. Right, it seems to us that the WTI oil prices have possibly reached a bottom from what we have seen with the data across the market. Right, first of all, the refinery utilization is coming up, right, from 80+%, low 80+% in March, till we're looking at 92% last week. Alright, so that is a very positive sign that demand is picking up. Right, so that translates to drawing down the crude oil stockpile in US, right, reducing the concerns over the potential build-up and overcapacity that all the storage facilities might not be able to take in all the oil that's on the oversupply of oil that's on the market. Right, so with that, we have two factors down, and then thirdly, alright, production volumes, the pace of production volume growth has also come down in US. Alright. So we know that the rig counts, land rig counts in US have come down. Alright, so that although it does not directly translate immediately into lower production volumes, alright, but must understand that when the rigs are coming down, that is a leading indicator to future lower production growth, right, and production volumes, right, for the shale oil volumes that we see in US, alright. But the other thing is that we need to know that for the production decline curve for the shale oil usually takes about 18 to 24 months. Alright, so some of you might also be familiar with this rough timeline. So given that point, alright, we should expect by the end of this year, right, for the production volume to moderate downwards from what we have seen. Alright, so currently, as of last week, the volumes have come down, right, the pace of growth, right, the data for from EIA is going to come up by Wednesday, right, so we'll know if the numbers continue, right, so if the trend continues, it's going to be a strong positive and reaffirmation, right, to WTI being bottom out, right. So previously we made a call sometime in March, right, for the situation to turn around, basically the oversupply situation in the US market to turn around sometime in May. Alright, so it has been our expectations in from the perspective of the data points looking more positive earlier than we expected. Right, so we have seen that over the last week and the week before that. So we look for more confirmation on numbers coming forward for the US market. So this affects the WTI side. Well, on the Brent side, right, it has also be positively impacted by this. Right, but we must take note that Saudi Arabia, right, essentially means OPEC has been increasing their production volumes. So this might be somewhat of a downward pressure on Brent prices going forward. Right, but the good thing is on the Iran side, the negotiations of the sanctions have not seen any major developments. Right, it might be at a roadblock currently. Alright, so that is a positive for Brent prices. Right, so that's it for the update on oil prices. Alright, for the Singapore marine sector, currently from our point of view, it's still pretty negative. Alright, you look at the two rig builders, Sarine, Keppel. Right, evidently business is bad for these guys. There have been no order wins in terms of rigs since the start of this year. Alright, so essentially they're just surviving on their backlog. Keppel released their results last week. Right, up to 8 rigs have been delayed by their clients. Alright, so potentially I think we might see some renegotiation of terms, right, going forward. We shouldn't be surprised by that. Right, on the Brazil side, about 40% of their order book, right, is filled up by SETI Brazil, which is linked to Petrobras. So there might be some payment issues. Their last payment was in November. Right, so as of today, they mentioned that they're still cash flow positive. Right, but we need to be cautious of how potentially payments as well as contract terms might be renegotiated on the Brazil side. Right, for Sarine, similarly as well, more than 50% of their order book, right, about 50 to 55%, is taken up by the SETI Brazil drill ships. Right, so that's going to be an issue as well. Right, Transocean has some drill ships with Sarine that could potentially be delayed. Right, and then there's also another rig order by Hercules from US that's within the Sarine order book, right, that might be potentially cancelled as well. Right, so we're pretty negative on the rig builder side. Right, Keppel is a little bit better off since their business has been diversified with the privatization of KLand. Alright,
when you look downstream, right, any form of asset owners, right, it's going to be quite painful, especially those who are in the deep water segment. And then service providers, if you're selective, right, there might potentially be value stocks that we can look at, right? So, but currently some of the service providers might be somewhat affected in the first quarter, right, such as Pacific Radiance, as many of the oil majors are more opportunistic, right, where they are renegotiating some of the terms, right, because of low oil prices. Of course, they want to reduce their costs as well. So we've been seeing some renegotiation in terms of, let's say, charter rates. And then on top of that, we are also seeing that some of the bids on the market, they are going to fight for tenders for contracts, right? People are also submitting bids at ridiculous discounts, like 30 to 40%, in order to stay afloat. Okay, so these are some of the private players that are not listed. So that's roughly it for the offshore and marine sector. Right, so I hope that gives you quite a decent view of what is going on. Alright, so with that, we have been running the webinar for an hour. There have been plenty of quality questions today. So we thank you all for coming up for asking all these questions. Right, been very happy to answer them. Right, and I'll end off the weekly webinar for today. So do continue to tune in for the next week, right? And we look forward to more questions from you, right? Thank you very much.